So today we're going to talk about our renewable energy fund that we're busy with. We're busy raising, and we're also busy looking at deploying, right? So it's quite an exciting opportunity, and I must say it's really one of these niche, exciting opportunities that offer you very good returns as an investor, and there's quite a bit of risk mitigants. So you've got fairly de-risked opportunity that, as it offers you very, very attractive returns. So if we go into it, and as I said, the fund itself, we'll talk about the mandate, but it's a renewable energy fund. So as you'd imagine, it invests in 2 renewable energy assets. But the important thing is that if you think about the renewable energy space, there hasn't been vehicles for individual investors to come in and play that theme. I mean, even if you look at the listed markets of the JSE, there's no counters that you can invest in to actually get access to this. So the one big benefit of this is the fact that the fund opens this up now to individual investors, which has traditionally been the playground of institutional players. So, you know, the big funds, the old mutuals, your standards, and they've benefited from this asset class. It is quite an attractive asset class, and we'll get into that when we talk about the returns and the cash flow profile of this asset class. So it gives you this opportunity to invest and to actually participate, as I said, in this very attractive theme. But it's structured around this tax wrapper, right? And gives you this very good tax efficiency. So even besides this attractive nature of this asset class we're investing in and what you benefit from as an investor, you've got this almost cherry on top. In fact, cherry on top is not the right analogy. It's a giant cherry, I suppose, when it is. This tax benefit and this very aggressive tax benefit that you get out of it, right? And it's probably your best tax structuring tool that you've got in the market right now. And we talk about that. And if you couple the two together, you do have this superior return. There's a good return from this asset class plus this tax benefit, and the risk mitigants that we put in place to protect you as an investor. The way you can come into this is in any form, whether it's in your own private capacity as an individual, whether you've got a business that has a tax liability, the business can invest in the fund and benefit from as the tax benefit that you get out of it, or the tax shield that you get out of it, plus the returns that come with it. Whether you've got a trust or a family trust or a business trust, you can come in. So your legal form can vary depending on your circumstances in terms of how you want to come in. I think taking a step back, first doing an intro, asking the question, who's Entropy Advisory? So I think also it's good to, at this point, to make the distinction that the fund itself, it's a registered fund, it's registered with the FSCA, and the fund is owned by the different investors coming in. Entropy Advisory, we are the fund managers. We don't own the fund. As if the fund is owned by the investors. So we manage the fund on behalf of the investors. And Entropy Advisory, I'd say there's 2 legs to it. There's the advisory portion, and hence the name Entropy Advisory. And that's really the corporate finance advisory work that we do. If you look at the team, the senior members of the team are effectively ex-bankers that come out of different parts of investment banking. Sorry, I forgot to introduce Terence, but Terence is on the line, my colleague. He's spent a lot of his career at Nedbank. He was one of the execs there. Myself, I've moved around with a number of investment banks, Tier 1 investment bank, like Standard Bank, UBS. So there's a strong team of financial fund managers and investment bankers that have come from different institutions, right? And that's why one of the legs that we hinge on is the advisory legs. We do a lot of corporate advisory work, and we've done quite a bit in the energy space. And hence we've got a strong record in terms of that, and we've got strong networks in the renewable energy space. And that's also what led us to this establishing the fund. On the fund management side, we focus more on niche opportunities. So something like this that hasn't really been brought to the market. and gives you, as I said, attractive returns for the amount of risk that you're actually taking in this fund. It offers you the superior returns. And as I said, because of our work in the advisory sector, we approached quite a number of times by individuals wanting to come into the sector, and there being no vehicle and saying, look, I've got a couple of million rands, can you get us into a project, for instance? It was very difficult. This fund allows you a very efficient way of getting access, as I said, to these projects and to the cash flow streams that come from it. I mean, maybe just not to labor the point, but as I said, you've got a strong, credible team behind you. I think that's the important thing. From engineers, I mean, I'm an engineer by background, but we're moving into finance. Clarence is a scientist. We've got accountants, we've got qualified CAs. With our partnerships that we've got with select vetted EPCs, you've got project management skills, you've got engineers. You've got a whole suite of an experienced team that sits behind you in terms of de-risking this and ensuring that returns are delivered to investors. If there's one thing you take away from this session today, I think this is it, right? So if you weren't paying attention, this is the time. There's two main reasons to invest into the fund as an investor. Number one is that it saves you money through the tax savings. So how does it do it? And I'll go into it in the next couple of slides. But it gives you this very aggressive tax deductions. So from a single investment this year, you get a tax deduction in this tax year and in the next tax year. And if you wanted to, because there's no ceiling, it's not capped, right? Your minimum investment is 200,000 rands, but your maximum is not capped. So if you wanted to, you could pay zero taxes this year, right? Depending on how much you want to invest. So as I said, it's very aggressive in terms of the tax deduction nature. And because of the way we've structured it, where you get a tax break this year from the single investment and a tax break next year, you're effectively getting all your invested capital back within the first 2 years. So you're getting about 60% back this year and about 40% the following year, right? I'm assuming this assumption it's you have the maximum tax rate. So effectively what it means is that SARS is paying for investment. Yes, because either you've got a tax liability, you pay it over to SARS and you walk away getting nothing out of it, or you invest it into the fund, you get either the tax refund from SARS, or if you haven't paid the tax, let's say you're a provisional taxpayer, you just don't pay the tax over to SARS, right? So that's what I'm saying. Effectively, if you've got a tax liability, either you pay it over to SARS, so you've already got this liability, or you put it into the fund and get all of that money back from SARS. And that's why effectively SARS is paying for your investment. The second thing is that you actually make money because you obviously invested now in the fund. So besides your tax deductions, above that, you're going to get returns. So the fund distributes cash every 6 months. It's a very cash-rich instrument, and the average cash yield is about 15% per annum. So this 15% cash yield is per annum, right? So your average is about 15%. It's not in totality. And I'll show you in the next 2 or 3 slides the cash flow nature of this. But I think the point is that you're getting all your risk capital or invest capital back within the first 2 years just from tax refunds, and that doesn't depend on the performance of the assets. So if the assets don't perform, you're still getting your tax benefits. So besides getting all your capital back in the first 2 years, as I said, you're getting this cash distribution every 6 months in cash, starting from year 1, and on average about a 15% cash yield, which is very attractive. And because of the nature, because of the regular cash distributions, because of the tax savings that you get, it's a very risk mitigated product. So even though you're getting these high returns, these attractive returns, the risk is materially lowered because of the 2 reasons I spoke about. So back to the fund. So what does the fund do, right? So you invest into the fund, and the fund on your behalf invests into these renewable energy projects. Let's take a typical example. Let's say somebody owns a warehouse and they don't have the capital or they don't want to put in the capital into putting in solar or putting in renewable energy on the warehouse. We'll come in, we'll design a bespoke solution. We'll look at the load profile, we'll look at the irradiation in that area, for instance, dusting. We look at their load profile as a load generation, and we design a bespoke solution for them that caters for their needs, for their property. We'll procure the equipment, we'll install it, and we'll operate it. And we'll bill them every month on their usage. And their rate is locked in because when we do the proposal, we do a whole business case for them in terms of this is, let's say we're paying Eskom 2 rands per kilowatt hour, our rate might be 1 rand 60, for instance. And the escalation is known. So we would say there's an annual escalation of 6%, for instance. Versus with Eskom, let's say at 60%, let's say it's 40%. So business owners don't want that variability. So for them, it's a no-brainer. They're putting in zero capex, and they're locking in a saving from day one. And they don't have to operate the asset, right? That we do, we remotely control it, we remotely monitor it. And as I said, there's a whole operations and maintenance strategy that we've got for the asset to make sure it performs to the stability. So what happens is that, as I said, we're billing the client every month. Most of that cash flows down to the bottom line, but there's very little expenses. Once you put in the panels, generating electricity is maybe a labor cost. So there's very little operating costs. So most of that comes to the bottom line. And as I said, that's distributed out to investors every 6 months. And that's why you've got this very attractive cash yield and a very attractive cash instrument. It's cash like annuity income that you get. The benefit for you as an investor coming into the fund is that you've got diversification across a number of projects. So, all your eggs are not in one basket, right? So you've got that diversification benefit. And also, with the partnerships we've got, we don't just have access to solar. I mean, to be honest, a lot of the projects, it's going to be skewed towards solar, but we also have access to waste to energy, to conduit hydro, those technologies that you as an investor will benefit from. And why that's important is if you look at waste to energy and conduit hydro, it's base load power. In other words, it's generating electricity, and therefore the client is being billed for energy 24/7. And whereas obviously with solar, it's generally when the sun is shining. So you as an investor benefit from that yield. It's very low operating costs, and therefore the margins and returns on those type of projects are much better than in solar. So putting this together, I mean, as an investor, I think the other benefit that you get in terms of coming into our fund, because of the work Entropy and relationship Entropy Advisory has in the renewable energy sector, is that we've got access to very good projects. We've got direct access to them. So we're not dealing with middlemen, and therefore there's this leakage in terms of returns to investors. And that's why you'll see that we've got one of the best returns, targeted returns out there in the market. The key investment highlights, I don't spend too much of time on this because we've covered some of that, right? But I think, as I said, minimum investment is 200,000 rands. It's a once-off investment. If you want to top up in 2 months' time or 3 months' time, you're allowed to, but you're not obligated to. And your maximum is unlimited, so that's not capped. So if you wanted to maximize your tax benefit, and we've got a tax calculator that we can share with you, you can do that. So you could invest, as whatever your number is, 1 million, 5 million, 10 million. We've got 1 or 2 investors that are coming in with big amounts to lower their tax liability. The targeted IRRs, right? And I'll talk about that when we look at the returns charts and the cash flow charts. But you're looking at a pre-tax IRR of 52%. I mean, this is very, very attractive, right? So what it means is that you're going to get 3 times your money back over the life of this fund. And it's very weighted towards the first few years. That you're getting your tax benefit in the first 2 years. You don't have to wait 7 years or 8 years to realize a return on this. You're realizing a return, big return up front, and every year with your cash distributions, you're realizing a return. So it all hinges on what they call the Section 12B. It's called Section 12B. It's part of the tax code, right? So it's not a loophole in the tax code that we found. It is a SARS legislated tax incentive. As I said, it's in the tax code, and that's the tax paragraph. It's Section 12B. It's been around for a number of years. So you can see it's been around since 2016. And what it does is it allows you, as an aggressive tax deductions for investments in renewable energy projects, because obviously we want to incentivize investment into renewable energy. And the fund only invests into the commercial and industrial sector. So in other words, we wouldn't do a solar project in Joseph's house. We would only do it for businesses, the commercial and industrial sector. And why that's important for the investor is that your credit risk is much lower. Because with the businesses, we've got track record. We've got their annual financial statements. We can look at, so we wouldn't invest in put a project in a startup business. So we'd see how long the business has been established, what's their profitability, what's their margins, what's their track record, what's the credit profile. So we can make a very, very informed decision in terms of whether this company or this off-taker is able to service this instrument that we're putting in, right, or the services project, and pay us every month for the energy that we generate. So what SARS has done is that they've aggressively expanded this tax deduction last year and this year. So this year is the final year where this aggressive expansion is in play. What it does is it allows you 125% tax deduction. And there's a table in the next slide that plays the scenario, and I think we'll see much better what that means. But basically, it means that if you invest R1 million, you can claim back a tax deduction of 125%, so 1.25 million rand. So not just on 100% of what you invest, on 125% of what you invest. And I mean, this is the first time I've seen SARS go this aggressive in terms of tax deduction. And they obviously did it because we're sitting with this spate of load shedding. And as I said, they really aggressively wanted to encourage investment into the renewable energy space. So the 125% ends this year. From next year, it goes back to the base case, which is the 100% tax deduction, but there's some restrictions on the projects as well. So this year, it's really lucrative, right? And therefore, we've still got this small window of opportunity to get in, to maximize your tax benefits out of this. But the other key thing is, and that's why I say, you've still got the small window of opportunity, is that the project, to qualify for your tax reduction or your tax credits, the project must produce electricity for the tax reduction to be clear. So in other words, when you invest, we'll have to deploy that capital on your behalf for you to qualify for the tax benefit. Now we've got projects. In fact, this week we commissioned, or we giving the go ahead on one. And there's a couple of projects that have been commissioned that we have to be procuring, right? So you've still got this window of opportunity, but you've pretty much got maybe a week and a half. In post that, it gets a bit difficult to deploy your capital to give you that tax benefit for this tax year. So I promised you this table that plays out the two scenarios and talks about this tax benefit that you get. So in the middle, we've got the individual or the investor who's not investing in the fund. And on the right, the same individual, same circumstances, who does invest in the fund. So if we talk about the middle one, who doesn't invest in the fund, his annual taxable income is 5 million rands. In year one, he doesn't invest, therefore he pays tax on 5 million rands. So assuming he's at the maximum marginal tax rate, this is how much he's going to pay over to SARS in this year, right? In year one. In year two, same scenario, he pays the same amount of tax, right? So he's paying about 4 bar worth of tax in 50 years. in the next scenario, as he invests into the fund, same, he's got the 5 million rands tax liability or taxable income. He just invests $1 million into the fund. His tax deduction, remember I said it's 125% thereof of his investment amount. So it's reduces, so his tax deduction is 1.25 million, just from a $1 million investment. And therefore, his taxable income reduces from 5 minus the 1.25 to 3.75. So he's only going to pay tax on 3.75. As I said, if he's already paid it through, so if he's a salaried employee, he'll get a tax refund, and it's fairly efficient. And therefore, his tax liability for the year is only 1.5. Right? So his tax saving is 500, just over 500,000 rands in the first year. Right? And that's why I say you'll get about 60% back in the first year just from a tax refund. In year 2, same situation. He's got taxable income of 5 million rand. He doesn't do a follow-on investment. So he's just done one investment in this year, $1 million rands. And he qualifies for a second tax deduction of 1 million rand. And that's because we bring in some leverage at the project level, unlock some capital that we deploy into a new project. And you as investor benefit from that, from the tax benefit, tax breaks that you get out of it. So he's, again, in the same scenario, 5 million rand he earns, or that's his taxable income, gets a 1 million rand tax deduction, and his taxable income is 4 million rand, and therefore that's the tax he pays. And this is the saving. Right, so if you're not astute in terms of numbers, I think the key is that if you invest $1 million rands through the 2 years from a tax savings point of view, whether it's tax refunds or just lower taxes that you pay over to SARS, you're getting your investment amount back, right? You're actually getting a bit more than that. So that's why I say from a tax nature, it's probably your best tax structuring tool that you've got out there in the market. If you wanted to, I mean, if you up this and you put in 4 million rands, your taxable income would drop to 0. So you pay and be liable for 0 tax this year, right? That's why I said, depending on how much you invest, you could get away having a 0 tax liability for this year. And you still get the benefit in year 2. And that's why in the first 2 years, from this aggressive tax deductions, you'll get your risk capital back. Remember, and I'll go to the next slide, is in year 1, even though you're getting the tax deduction, you're also earning an income, right? You're earning this yield on the investments we're doing on your behalf. As I said, what does the fund do? It invests on your behalf in these renewable energy projects. The off-taker pays us cash every month, depending on its usage, and that is distributed every 6 months, collected and distributed every 6 months to investors. So from year 1, you're actually getting a distribution from the fund. And that's why if you look at the cash flows, it's very regular cash flows that you get every year. It's a 10-year fund life, but every year for the 10 years, you're getting regular cash distributions. You've got obviously this big weighting in the beginning because of the tax breaks that you're getting, the tax refunds that you're getting. And your cash yield, remember I said on average it's about 15%. It starts a bit lower, but it beats inflation. So you've got an inflation beating instrument here because our increases that we price to the offtake is either 6% to 8%. So you're beating inflation. So your cash distribution every year is going to be higher than it was the previous year by more than inflation, right? Either by 6% to 8%. This is just a tabular form of what we spoke about. I think the important thing to focus on here is probably the last 4 or 5 rows. So you're getting about almost 3 times money back. So the same situation, this investor has invested $1 million rands and is getting out almost 3 million rands back, right? So about 3 times money back. And a lot of that is in the first 2 years, right? Because of the tax benefits that it's getting. If you look at pre-tax IRR, I mean, if you are looking at comparing, getting a 52% pre-tax IRR, which is phenomenally good, right? You're getting your cash flows upfront, regular cash flows, and getting about 3 times money back. So if you look at typical private equity, for instance, they'd target 20%, some would struggle to even get to 20% IRR. So that's why I said you've got a very attractive returns out of this. So in terms of the project, as I said, we've built up a strong project pipeline because of our networks in the market, and we're always building, right? We've always got projects that are coming through because besides partnerships we've got, we're also getting fairly aggressive in terms of marketing the offering to business owners. So in this year, well, last year, in FY24, we priced for about R1 billion of projects. I think the point is there's a number of projects, number one. Why that's important is that when an investor, we're not obligated to invest in a project. We can screen projects to select the best ones, give the best returns and most risk for the investors. Number two is that the project sizes, some of them are actually well sized, right? So we're not targeting very small projects. The problem with very small projects is that the returns are low, number one. Number two, your credit risk is high because generally for a very small project, it's a very small business, and therefore the balance sheet and the cash flows aren't as strong as a bigger project, which generally means a bigger business, right, and a more established business. So you as an investor benefit from this lower credit risk and this more attractive and better projects with higher returns. We're almost at the end, and then we open it up to Q&A. In terms of the procedure to invest, it's a very simplistic procedure, to be honest. You can reach out to either myself or Terence, or on our website, there's an investor email address, and we will send you the application form. As it on our website, there's even the brochure that you can download. There's a bit more information. There's, I think, our previous webinar that's loaded there as well. It's fairly simplistic application form to fill in. We're here, teams here. We're ready to help you if you do have any questions and queries. There'll be some FICA documents, as is customary, that you need to submit. And then it was designed where you put in the 10% deposit, which is still the case. It's just for this tax year because, as if we at the end of it, the call is fairly aggressive. Previously we had that balance would be paid when we call for the capital as we deploy the projects, or by end of Jan 2025. We obviously at the end of Jan 2025. So, effectively, you would need to, if you invest in 200,000 or 1 million, you should be in a position to deposit that through to the fund account, right? So it doesn't go into our account, it goes into the separate fund account. And then you get the investment confirmation, and when we deploy the capital, we send you a tax certificate. And then when you do your tax returns, as you do with any of the items, there's just a code that you add on. We'll send you a how-to guide that we can guide you if you are struggling. And it's as efficient and quick and painless as that. We're at the end. I mean, as I said, it is a phenomenal opportunity. Myself being in financial markets for a number of years, almost 2 decades, and the rest of the team, it's objectively as well, I can say that it is one of these niche attractive returns that you get access to through the fund, right? This is niche opportunities. The tax incentive isn't going to be around forever. That's basic. It was done for a purpose, and that was to attract investment into the renewable energy sector. At some point, SARS will terminate it, right? They haven't declared a sunset yet, so we know obviously is in this year. It'll continue next year in terms of going back to the old B. And I'm not sure how much longer it'll go on for. So there is a window of opportunity. There's an aggressive tax benefit to invest this year, right? So I would encourage you to take the time I think the fact that you're on this webinar is testimony to that. And then post that, there is still an opportunity, but as I said, at some stage, I believe, that's my opinion, that it will come to an end.